I've been working in property for over 10 years, and even though a lot has changed since I started, there are 3 mistakes that beginners were making back then that they're still making now. And as property prices keep on growing, these mistakes just become more and more expensive. So let's take a look at what the 3 mistakes are, how you can avoid them, and most importantly, how to get the best bang for your buck on your early investments. And the first mistake is people that tend to brush over because they get excited. But if you want to invest, you need to go in with your eyes wide open, because being a landlord isn't as simple as buying a property, renting it out and collecting the rent. Sure, in the 90s or early 2000s, you could dip your toes into the property market, make a bit of cash on the side, and call it a day. But today, the game has changed. The property market is much more regulated, which means it's much less forgiving of newbie mistakes. I'm not saying you need to go full-time and become a professional landlord, but you do need a solid understanding of the rules and legal responsibilities. We recently had someone write into our Sunday Times column that really highlights how wrong things can go for first-time investors. This investor was trying to evict a tenant who hadn't paid their rent for months, and after a long, stressful process, it looked as if everything was going through. But then, at the very last minute, the court rejected their case because the landlord didn't have a local authority license, which is a legal requirement in some parts of the country. So not only did they lose the eviction case, they were also hit with something called a rent repayment order. That means that they had to pay the tenant back up to a year's worth of rent that the tenant had paid while the property didn't have the right license. I'll let you decide whether that is fair or not in the comments, but the result was brutal. Not only were they stuck with a tenant who's not paying rent, but any money that they had received would have to be handed back. Say the rent was £2,000 per month, and this was in London, so that would be low. That is £24,000 of missed income. And even without that income, they still need to make their mortgage payments and meet their other expenses, not to mention their legal fees and their lost time and stress. Suddenly, that one mistake of not knowing they had to have a license turns into a financial nightmare. This is just one example of huge costs that can come from seemingly small oversights. The same can happen if you don't protect your tenant's deposit in an approved scheme. And although this has been the law now for 14 years, some landlords still aren't aware of it. That mistake can leave you having to repay your tenant 3 times the amount of their deposit. So the moral of the story here is, when buying a property for the first time, don't skip over any detail. And if you don't have all the details or you don't know what to watch out for, you can download our lettings laws checklist in the description, because getting the right license, protecting tenant deposits, complying with local housing laws, or anything else could be the difference between a profitable investment or a £24,000 size hole in your pocket. But even that isn't much compared to mistake number 2. Imagine you're at an auction. You've been scouting properties for a while, and today you found the one. It's a fantastic property, well below market value, a once-in-a-lifetime opportunity. But then you realize something scary. Because it's in auction, there's no time to arrange a standard mortgage. So unless you've got the cash, you've only got one option: short-term financing. If you haven't dealt with short-term financing or bridging loans before, they do exactly what they say on the tin. In as little as a few days, you can get a loan for up to the full value of the property if you've got other assets to put down as security. However, as you might have guessed, there is a downside. The interest payments can be north of 12% per year, plus fees of at least a few percent more, which is much higher than your standard mortgage rate, which might be closer to 5% per year. And that's enough to make most beginners walk away from the deal, because high interest rates equals high risk, right? Well, yes, but when we run the figures, it might still be worth it. Let's imagine you take a short-term loan of £150,000 with a 1% monthly interest rate. That means you'll pay roughly £9,000 in interest over the first 6 months, which might feel like a lot, but after 6 months, you refinance onto a standard 5% mortgage, and then you hold onto the property for 10 years. If you're buying at the right time and you've done your research well, then the property price will inevitably go up over time. So although you have 6 months when the interest payments are high, you then have 9.5 years of rental income and, more importantly, capital growth. Because let's say you use the loan to buy a £200,000 property that increases by an average of 5% per year. In 10 years, it could be worth £325,000. So for the sake of a £9,000 bridging loan, you might be giving up on £125,000. That's not even considering the savings you've made at the start from grabbing a bargain, and hopefully you've added some value by refurbishing it too, because most auction properties aren't exactly move-in ready. Now, of course, this is just an example. There are lots of caveats. There's a lot that can go wrong and mean it's not going to play out like that. Of course, short-term finance is risky and not to be taken lightly, and I'd urge anyone without experience to be extremely cautious when using it. But exactly the same logic applies when you're buying through an estate agent and using a normal mortgage. I often see people looking for perfection and running extremely conservative cash flow forecasts that leave the numbers looking distinctly unappealing, even on decent deals. But the real question is, will this property perform well in the long run? Because what makes you money in property is time. Over the years, you can be pretty confident of your rent going up and property value going up too if you bought well and bought at the right time. So while of course you want a good deal, you don't need to spend years and years searching for that elusive gem that has no risk at all and blows you away with its returns from day one. And speaking of time, that reminds me of another mistake that could cost you a small fortune. So back in 2020, when the pandemic hit, the property market came to a complete standstill. Everyone thought the market was bound to collapse and anyone buying property was a complete nutjob. So I bought a property. Yes, it felt slightly risky, but pandemic or not, I held on to an almost stupidly simple fact. People always need places to live. And guess what? Since fewer people were buying, I got a giant discount on the purchase price, and that property has ended up being one of my best investments by far. On top of the discount, the local market has gone up by at least 15% since then, and the rent has gone up by £300 per month. But even if it's not as extreme as a pandemic, there's always something that means beginners feel safer if they wait and see how it plays out before taking the plunge. Unfortunately, I see this with some of our podcast listeners who've been tuning in almost every single week for over 11 years. But every year, they find a new excuse to put things off. In 2016, it was Brexit. In 2019, it was Jeremy Corbyn. In 2020, it was COVID. And in 2025, I'm sure there will be another reason. They wait for the market to settle down and for everything to be just right. But the truth is, if you're always waiting for everything to be perfect, you'll never take action. There will always be risks. Prices always look scarily high. Politicians are always planning something, and the economy always seems to be doing too well, which can push up interest rates, or too badly, which could mean unemployment and a house price crash. But instead of waiting for the stars to align, ask yourself, if the market dips, can I hold on to this property for long enough to ride it out? If interest rates go up, do the numbers still work for me? Is this investment strong enough to weather the inevitable ups and downs? And above all, in 10 years' time, am I likely to be grateful to my past self for having had the confidence to invest? When you stop worrying about the temporary risks and focus on the long term, you'll realize that they're not half as scary as they seem. But I appreciate that this is easy to say and very hard to actually do. When the news is sending you dramatic stories about crashes and pandemics, it can be hard to keep your cool. But there is one thing that can help you overcome these fears and drown out all the noise, and that is having a rock-solid understanding of all the numbers. So check out this video next, where I explain step by step all the figures you need to make the right decision on your deal.